Welcome to No Fluff, Just Ideas. This is your host, Sophocles, and we're going to be discussing investment ideas from around the world. So buckle up and enjoy. This podcast is for educational purposes only. Full disclaimer at the end of the podcast. So today we have a very special guest. We have Steve Gorelik of Firebird Management out of New York, but though Steve is now in London. He is manager of their US fund, but also portfolio manager for their Eastern Europe fund, where Firebird has a very, very long experience. Of course, today, Steve here with us will be talking about a US company. Welcome, Steve, to the podcast.
Thank you, Sophocles, and thank you for being a great friend. And I think we've known each other for about 10 years, and I have to give you tremendous credit for the work that you're putting in and put in building the conference right now for me is one of the highlights of the year, and going to Cyprus and with this podcast. And I'm really enjoying this friendship and be looking forward to the conversation.
It's been great knowing you. You actually came to the first Cyprus event 10 years ago.
In Nicosia.
And I instantly recognized what a fantastic investor you are and how in-depth you go for each company. And I think I even mentioned this once where you were telling me, oh, you might be speaking or might not be speaking at an event in Europe. And I said to you, well, are these people crazy? How can they not want you to speak at an event? So what's the company here? And please explain to us what this company does.
Sure. So the company I want to talk about today is Akamai Technologies. The ticker is AKAM. It trades in the United States. The market cap is about $12 billion. And in order to understand Akamai and what it is, I think we have to go back a little bit into its history. So the company has actually been around since late 90s. And the first business for them was this idea of a content delivery network. And the content delivery network, in the simplest terms, is a way to get the information that is on the internet to the final consumer faster. And we could be talking about a uploaded video from something like Netflix that is in a central database, but in order for a person in Cyprus or in London or in Malaysia, pick a place, to be able to watch the video without a delay, it has to be moved to a location that is closer to the user, and that those locations that are closer to the user is the content delivery network. Same thing with video games and a number of so it kind of reduces the content delivery network, reduces the friction on the internet, and reduces the latency. Akamai was one of the pioneers in this business in the 90s. They have built the biggest and the best network, content delivery network over time. They are all constantly investing into it. So this is definitely a core asset for them, with 1,400 points around the world. Actually, 4,000 points around the world. And so this is a main differentiator for them. This business, while initially in the 90s was truly unique, and if you can actually look at the stock chart of Akamai from the 90s, it was one of these companies that went to the roof, and still the stock price is nowhere close to where it was back then. But over time, this business, while they're still very important to the customers, what customers started doing is that they started diversifying. So it actually makes sense for you to have multiple content delivery networks, not just one, so you're not reliant on one provider. But their largest customers, the Netflixes of the world, Amazon, have started to internalize some of this content as well, and some of this traffic, because they have developed enough of their own expertise, and they knew that there's enough traffic going on that it made sense for them to start investing into it themselves. So as a result, this content delivery network, while the amount of information being pushed through is constantly going up, the revenues from this business started declining a few years ago because there's more competition, and the customers are starting to take this business in-house a bit, while still using Akamai for other services.
Is it also cheaper to do the content delivery business?
if you're large enough, if you're large enough and you know that there's a certain amount of traffic that you will always have within certain locations, it is definitely cheaper for you to put up your own endpoints and put up your own servers and do that. But you still need something like Akamai for the spikes in demand, or maybe for locations where you don't have that many users. So Netflixes of the world still use Akamai, but not as reliant on them as they were in the past. So you can think about it as there's a certain amount of traffic that they feel like they're going to have, and from that point of view, it makes sense for them to have their own. But as far as but you still need somebody like Akamai or one of its competitors in order to be able to augment that network. But what Akamai has done, and I think so, the delivery and this content delivery network is called Delivery Business, and that is one of these, you can call it melting ice cube, but like it's a declining business, and if it was just that, this company wouldn't be interested. But what Akamai did is they used this network of servers, and most importantly, the relationships that they have with the CTOs and CIOs of number of largest companies around the world. So they have over 1,400 customers, enterprise customers, paying them for this content delivery network. And they start to figure out what else can we sell to them that is within our core competence. And the first business that they started building out is what they call the security business, so online security. And within that, there are within the online security, there's certain things that actually make sense to be happening on the edge. So things like authentication, the denial of protection against denial of service attacks, and all of these things. So the way that Akamai has built this business is they usually would acquire a competent but small player within a particular space, and then cross-sell their services to their customers. So when they would acquire a business, they would probably pay a fairly high multiple, like 10 times sales, something like that, which would look pretty expensive. But the growth in revenue after the acquisition is quite rapid. So they've built and the security business at this point is larger. So before, if we look back, I don't know, 5 years ago, 6 years ago, most of the revenue was coming from the delivery. Right now, delivery, which is declining, represents about 30% of total sales. So still meaningful, but not as meaningful as security. And there's also compute, which I'm going to talk about in a little bit.
Yep, so I see that actually. They actually published some numbers on that. I put it on a Substack piece yesterday. For those of you who want to check that out, it's fatalpha.substack.com. And you can see that, security was 1 billion in revenue in 2020. It went to 2 billion in 2024.
Yeah.
So it went from 1 to 2, but delivery went from basically 2 billion down to 1.3 in 24, and it's still declining.
Exactly. But the security business that they have built, as I mentioned, through acquisitions, and they spent about $2 billion on acquiring assets over the years, including they paid for $150 million recently for this company, No Name, which is an API security. So this is a very fast kind of key growing segment of the security business for them. They have acquired a company called Guardicore, which is in segmentation and zero trust security. So they've been acquiring different pieces that they can cross-sell to their customers. But the key point is that they may be paying fairly high multiple for this asset initially, but they know that they can cross-sell to customers. With $2 billion of M&A, they have built a security business that now has revenues of over 2.1 billion and is growing at 10% a year. It used to be 15 to 20. Now the company says, because a large part of it, like the protection about against the DOS attacks, something that they have acquired in 13, they've cross-sold to most of the customers already. So their natural growth rate there has slowed down, but it's still a business that they expect to grow about 10% a year. So that's the security. And then, so this is kind of a little bit going back into history. I've been looking at Akamai for a while, and I looked at it. I started looking at it in 2016, actually, when this delivery business started declining. it started getting cheaper. So I started looking at that point, and I spoke to a couple of companies, including one fairly sizable gaming company, who is a customer of theirs. And I asked them, well, how do you guys use it? What is it good for? What else would you want to do? And they talked about how important it is as a delivery, not a CDN and a delivery network. But they said, I wish they had a compute part to them. And the compute part would be, you can think about it like kind of like AWS, but instead of it being in central places, in large central warehouse data centers, this is compute that happens on the edge. So they have, as I mentioned already, 4,000 locations around the world, and the compute business is different type of computations that you can be doing on the edge instead of in a central place. So it could be things like sometimes there's information that has to be processed locally. So if it has like healthcare data, for example, quite often cannot leave the border because it's highly sensitive. So a lot of the governments will say healthcare data cannot leave. Financial data can't always leave a particular border. Going back to the example of gaming companies, things like computation of leaderboards, it's best when it happens on the edge. And as it's becoming more relevant today, things like AI inference also happens on the edge. So they are quite good at having that business. And so before, they didn't really have that business up until 22 or 23, I don't remember, when they acquired this company Linode, which is a edge compute provider. And they once again took a business and they're building something on top of it that they can cross-sell to their customers.
Is this like where you're running like a virtual machine for, or is it just like you said, or is it just the data? So is it like because there's some, gaming thing that's being run, it has to be closer to the person, kind of like content delivery, but instead of content, it's like a whole computer being run in the cloud?
Yeah, but I think virtual machine on the edge is a good comparison as well. So it's about the computation that has to happen on the edge as opposed to in a central cloud. And that way it happens quicker. So it's not applicable for most applications. And sometimes you need a massive computing power to calculate. So for things like building the LLMs, the multi-gigawatt data centers that we're talking about, it wouldn't be useful for that. But for computations on the edge, some less complicated calculations that don't need to happen in a central place, this is useful. And when they acquired Linode and they talked about, well, how big of a business could this be? They said, look, we can fight for maybe 2-3% market share in global compute but it's a $200 billion business and growing fast. So if they get to a 2% market share within that, that's a $4 billion revenue business for them. So this is kind of in terms of what they're talking about. They're nowhere close to that at the moment. So they just talks about the amount of runway that they have. And this compute business, since they have acquired it, has been growing at 30 to 40% per year. So that's something that's becoming a third leg of the stool that is very important to the story here.
Yeah, I actually see that their revenue from compute has tripled since 2020. And I didn't know it was so big. So, can you tell us a little bit more, like, is this something that all companies are using, or is it just large cap companies are using?
So there, it's actually a very good question. I think it goes in comparing them to a kind of public competitor like Cloudflare. So what these guys have is they have a tool that is primarily used by larger enterprise customers, including some of their competitors. So for example, in the last quarterly calls, they talked about how all three large hyperscalers are actually their customers, and they recently signed the third one because they have certain capabilities on the edge that are complementary to what the Amazons of the world are doing in central clouds. So they're using the Akamai's network because they know it's going to be complementary, and that's absolutely fine. Cloudflare is very good at helping out smaller customers and helping out smaller startups. For that, This particular system is Akamai system is probably too robust. It's too good. It's too expensive. So from that point of view, and that's why you're seeing higher growth in a company like Cloudflare that is addressing a lot of these startups that are popping up. But as the companies mature and their security and delivery needs become greater, and they have to, and the need for reliability becomes greater, then they naturally will become a customer of something like Akamai.
You used before the example of healthcare hospitals and that being run in this compute. Could you explain that?
So it's an example of in UK where I am right now. You have regulation that data that is healthcare data related to the customers cannot leave the border, so cannot be taken by something like AWS and processed in United States. That can't happen. It's illegal. So the data has to stay local, and that's where uh, and maybe UK is a bad example because the Amazon probably has servers in UK as well, but there are places where they don't, which would have similar regulation. And to the extent that anything that has to happen to this healthcare data from a point of view of processing or whatever it is, it makes sense to be using the edge network that of somebody like Akamai to make sure that it stays local.
And I guess this is something going on then with TikTok, right? So where the data can't go to China, it has to stay in the U.S. for U.S. citizens. So I guess sort of maybe that's a client of
Tik,
Akamai.
TikTok is definitely a client of Akamai, and that's actually one of the reasons for why the delivery business has been declining for them. For example, last year, is because of TikTok's difficulties in the United States, and they were actually moving some of so they were reducing the amount of data that was being sent. And I think they internalized some of it as well. But they talked specifically about the delivery in terms of the revenue declines last year. Some of it was linked to TikTok. But kind of putting all of this together, okay, and why is this important? So you have kind of three parts to the business. You have the delivery that is declining, and last couple of years it was declining by double digits, but there's certain reasons for it in terms of competition and large customers internalizing a portion of the traffic, not as much traffic being there. So at the end of COVID, there was a lot of capacity for data. Moving data has been put up around the world. After that, the demand, the amount of data as people went back to work and started watching less videos, the amount of data increase in the amount of data being sent around has declined. So because of that, you had quite a bit of pressure on pricing, and you had a double-digit decline in revenues from delivery over the last couple of years, but that is actually normalizing. So the competitive environment is getting a little better. So a couple of companies in the space that were discounting actually went out of business last year, at the end of last year, and Akamai bought their essentially customer list. And that's a really great transaction for them because they don't need to spend anything on network, on the capex in order to use to serve these customers, because you already have all of that in place. So essentially just paying for the customer list. And it's a highly profitable transaction for them. But it also improved the competitive environment. And also this period of lower growth in amount of data is coming down. So the company thinks that going forward, instead of declining double digits, this business should be declining, call it 5% per year. But it's also has now gotten to be small enough, so it's 30%, so it doesn't have as much of an impact on the company. Security, that is growing about 10% per year. And then you have the compute that has a slower growth rate this year because there's some legacy. So they have this the actual compute on the edge that they acquired with Linode, and they're investing into it. So that is growing at 30-40% per year. And they had some legacy compute that were things like call it the just data storage on the edge. So like not as complicated as the actual computations. So they're transferring some of that business to the customers, and in exchange for these guys becoming their Linode customers. So because of that, the growth rate in compute is lower this year. So it's looking like it's about 15%, but it should reaccelerate next year again as the compute on the edge is becoming more relevant, and actually as AI inference is becoming more relevant. The reason why I like this company is that the combination of those factors is that this is a company that, even with the delivery declining as much as it did, was still delivering growth of low single digits, call it between 3 and 5% per year over the last few years. But as the business is getting smaller and the other two businesses are continuing to grow, it's just natural for the growth rate to increase. And we saw that starting to show in Q3. And I think coming into next year, we're gonna go from mid-single digit growth rate to high single digit growth rate, with the potential of getting to double digit growth rate. And the reason for why I like this company is because you're really not paying for that rate of growth. So this company is not valued as a company that's growing at 8% per year. It's valued as a company that's growing at 2 or 3% per year. So as you are getting to that inflection point, it's going to improve the profitability of the company. And there's a chance, I never count on this from point of view of how I'm thinking about the investments, but there's a chance that it will also lead to multiple expansion. So not just the earnings growth, but also the multiple expansion. So our investment philosophy is to buy things based on the earnings growth and can assume what is a normalized free cash flow yield that the market is willing to pay for this. But sometimes things get crazy, and we want to be in a position where things could get crazy in our favor. Sometimes they go that way.
Do they break out the margin for each of these segments?
They do. They do. So, and they had that information in their investor day from 22, but they essentially the division level profitability is that when we're talking about EBITDA, they expect the delivery delivers also just on division level. This is not taken out, not considering corporate G&A. Delivery, which is their oldest business that's declining, their EBITDA margin there is called like 44%. That's what they said. The margins, the EBITDA margin in both security and compute is higher. It's at 46 or 47%. So their overall margin as the business is shifting towards these two segments should be getting, it actually hasn't been getting higher in the last couple of years. In part is that they do a very good job of breaking down their costs into components. And you can see that one of the areas of growth that has been increasing for them, of cost of goods sold, is something called co-location fees and network build out. And this is them building out the network for the compute business. So this is something that you have to build it first in order for them to be able to sell it to customers. So they're now in the building stage, and I think coming into next year we will start seeing the benefits as they're getting more and more customers on the compute. We should start seeing that benefit from the margin point of view.
The one thing that concerns me is, like you mentioned earlier on delivery, there's increased competition, revenues coming down. How are they doing competition wise in security and in compute?
So competition, obviously there's a lot of different choices in both in the compute and in delivery and in security. So there's a lot of vendors out there. What they do very effectively, and as I already mentioned, is that they have the customer relationships where they have the foot in the door to be able to cross-sell these other services. So I think they do. It looks like they're gaining share in total security spend. They are gaining share. So it is growing faster than the total security spend in the world. And I think they're doing that as a result of having these relationships. As far as the compute is concerned, it's still a relatively young business for them. So they're talking about signing up large customers that with $100 million of revenue per year. So they're still kind of in the part of proving out that they have the robust enough network to be able to serve these type of customers. They had a very interesting announcement just in October, and part of the reason for why we see the stock price going up recently is because they announced that they have now a partnership with NVIDIA, just like everyone else. And but this in their case specifically, it's about putting up the Blackwell chips in the compute locations that they have around the world. And frankly, this is a thing. So if you look at the recent announcements from companies like CoreWeave, that are reason for why those shares are down in the last few days, and not to be too recent in terms of how what we're discussing, but they're saying that we have plenty of demand for what we're doing for the compute, but we don't have the ability. We're not hooking up the data centers fast enough. What Akamai has is they have locations around the world where you can put up a Blackwell rack, which is what they're starting to do. And they're partnering with NVIDIA on that. And there's clearly a demand for this type of product. And as we're moving from training models to inference in terms of how the AI is developing, a service like that is becoming more relevant, and they're preparing for it. So this is development that's quite exciting, that it once again uses the natural competitive advantages that they have.
Can you explain a little bit about how this comparison here with like CoreWeave are they
No,
competing then with
different
CoreWeave?
use case. No, they're not. So CoreWeave is kind of, think about once again, you have AWS, which is massive cloud locations where you can do really complicated calculations. When you look at for CoreWeave, when they're talking about their contracts with Microsoft or OpenAI, it's for training the large language models. That's my understanding. I'm not an expert on this. I'm a generalist. So if I'm saying something that doesn't make sense, I would love somebody to kind of follow up with me and say that this makes no sense. That's part of the reason for why I do these things, is to learn. But my understanding is that when you're talking to companies like thinking about companies like CoreWeave, it's about training the large language, mostly about training the ability to train the large language models. When we're talking about the service that Akamai would provide, it's about inference. It's about using the information that is already in the. It's not about teaching the company. I don't know. When we're talking about training large language model, is you have this computer that a year ago was as smart as as knowledgeable as a 7-year-old, and then it becomes as knowledgeable as a teenager, and now it's as knowledgeable as a college student. So it's not about building up that knowledge. It's about asking that college student the question on any topic. And that part is the inference part. And that's where it becomes the network that Akamai has becomes more relevant. And once again, if it's on the edge, you get the answer to that question.
So who else is doing this?
Great question. I'm sure if you look at their competitors like Cloudflare and DigitalOcean, I'm sure they're doing that too. But once again, what Akamai has is the biggest and the best content delivery network around the world, where you can add these type of machines. And they have the experience of managing extremely complicated global systems.
That's why I'm kind of like asking this, because it seems that it's not a name which has popped up in the
No,
whole AI craziness.
despite this is funny, but like I was talking to one of my partners and we were talking about Akamai, and he's like, "It's in the name. It's Akamai," which I thought was pretty funny. I actually didn't think about it that way. So it's an opportunity missed.
Well, if you present it somewhere, you could just, you have a slide and you
Just
just
capitalize the
hover.
last two letters and it goes up in
Yeah,
price. It doubles.
that's all you need. Yeah, because, you look at some of these other names and like, like I posted in that piece, it's like, Cloudflare is like, 300 times whatever metric you want.
It's growing faster. It's not as profitable. This company is in the wheelhouse. It's exactly the type of companies that we're looking for. And we've had a number of successful investments like that, where you buy a company for the business that it has, for the capital allocation that it has, for the profitability that it delivers. And then you can have a different use case develop over time that creates a certain amount of excitement about the company that accelerates the growth. It could be so without the in AI inference, this was already an interesting story. But it could
Mhm.
become a really interesting story if you start seeing this massive growth. Like companies like Nebius is talking about their expected ARR to go up 3 times. Nebius is expecting to grow their ARR 8 times next year. So there's massive demand. Put up a data center, it's going to be used up, at least in the next 2 or 3 years.
So basically, if you have this growth in the data centers, then you'll also have growth in this inference and you'll have growth in Akamai.
Yeah. So you should be getting this significant growth in the compute business that is actually now becoming reasonably sizable. So I think this year they're going to be over $700 million. So the company as a whole is about $4 billion in revenue. We talked about security; it's about 2.1. You mentioned that delivery; it's about I think 1.3, a little less now. And then
Yep.
there's about 700 million in the compute. So if you're thinking about from a point of view of different growth rates, so like if you have a $2.1 billion revenue business growing at 10% per year, you have a $700 million business growing at 15, probably 20% per year next year. You have a $1.3 billion revenue business growing down by 5% a year. So the result of those three things, you get an accelerating growth rate that I would argue will, as I already mentioned, will have an impact on profitability and may have an impact on the multiple that is being paid for this, because if you look at a company like Cloudflare, the multiples that we're talking about are extremely different.
I mean, what can go wrong here? What can go wrong with this case? I mean, what is it that you're looking at where you say, if this happens, then I'm out?
It's a great question. I think is that if you see, so if something like security business, and this is to your point about competition, turns into a declining business. So this like the different services that they're selling against the DDoS attacks. If all of a sudden it goes from a business that it normally grows at 10% a year to start growing single digits, and then because you have a lot of these parts they've been selling to the customers for 10 year plus, lose relevance or for some reason start declining. So if that starts dropping, then you will have a business that once again goes back to a growth rate of low single digits, and frankly wouldn't be that interesting. But I'm looking for a business. I think this is a business where the growth rate is going to accelerate, and that is interesting because otherwise I've lost too much money by waiting for companies to turn things around and saying, "Oh, we're still earning plenty of money. It's a declining business, but we're earning plenty of
Yeah.
money and we're buying back shares." It's unfortunately, I haven't seen that work, or at least hasn't worked for me in a really long time. So I kind of moved on. Thanks.
Yeah, it's tough. I've been there too. But I don't think security in any way. I mean, I don't know. It seems to me that you can only lose in security if your product is just inferior or if your price is just insane, because security is just in more demand than ever than
Exactly.
ever.
Exactly. And things like as we getting into as AI is becoming more prevalent, protection against DDoS attacks, zero trust security, all of that is becoming only more relevant, and they have the products for it.
It seems that all of this is actually like you have the good players, actually also have the bad players who are just using automation and
Mhm.
AI to increase.
That's exactly my point. That's exactly my
I
point. So
mean,
you need to be able to protect against that.
I have like a couple of stupid little websites, and you can't believe I get these like security alerts that people are
Right.
trying to hack my website, and I was like, really? Who cares about my shit?
It's a good website, Socrates. I could see why they want it.
My only conclusion is that they're doing this everywhere, nonstop, on
Exactly.
anything that's on the internet.
It has become easier, and as it becomes easier, the security becomes more relevant. That's my take on it. So, but to your question of what would scare me, what would get me out of the stock, it would probably be that, right? Because then you're waiting for a long time for things to turn around, and
Yeah.
there's an opportunity cost to it.
So would that be the same with then with compute as well? If you see compute not growing, then again you
Yeah,
would be out.
yeah. So you because quite often what happens with businesses like that is that you have a change in mentality. So I think Akamai is a reasonably attractive place to go work, especially in places around the world like they have. So they have a massive development business in Israel, for example. So they are a employer where you want to go work for. Once you get it becomes an organization where the revenue is declining, I think the best people go try to find something else. So from that point of view, you start getting the quality of the employees that you have becomes different. So then maybe the quality of service becomes different. Then the customers start looking around, okay, who can provide me a better service? So from that point of view, there's like this, there's virtuous circles, and then there's non-virtuous, like whatever the opposite of the virtuous circle is that you have a business that is slowly falling apart and then starts falling apart rapidly. And that's part of the reason that's kind of my learning in more than a decade of doing this and more than 20 years of investing has been you want to be in situations where companies are delivering value for the whole ecosystem. You want to, because within that, you have the right employees, you have the right customer relationships, you have the right product. And from all of that, the value is being built. And I think Akamai is a company like that. But if it's not, then I'll change my mind.
What about, and you touched before on capital allocation. I see that if you look at the last decade, it's the return on equity is like some between 10-14%. Nothing like nothing too spectacular. What do you think that their capital allocation has been good, bad, average? Have they, acquisitions worked out for them? Have they made any big mistakes?
Yeah. So I think there's two major places to which sorry there's two major places to which they're allocating capital. One is M&A. So they spent a little over $2 billion on acquiring the different pieces of what is now a security business, and they spent $900 million on acquiring Linode, which is the core of their compute. With $2 billion, they've built a business that has $2 billion in revenue. It has a bit more, but for simplicity's sake, it has $2 billion in revenue. These type of companies growing at 10% per year, security business, what kind of multiple does market pay for them on price to sales? 7, 8, 10 times, right? So I think they have clearly delivered value with these acquisitions. With Linode, they paid $900 million for this business. I mean, it's a little bit of a kind of not necessarily comparing apples to apples, but right now they have a compute business that has $700 million in revenues. There's additional investment that had to go into it from a point of view of building out network, but it does look like another good acquisition that uses their core competitive advantage that they have. Once again, the network of servers around the world, the customer relationships, and is finding a way to cross-sell another product to them. That to me seems like another good acquisition. And then, so from an acquisitions point of view, I think they have been adding value because they're buying things that they know that they can sell to their customer base, and they're doing that effectively. And then from a point of view of the repurchase of shares, they are sent a good chunk of the remaining cash flow into share repurchases. Some of it goes to cancel out the share issuance, which I think you mentioned in your article that this is kind of one of the knocks against the companies. They're issuing a lot of shares to their employees, so that money goes to offset that dilution and then some. And they usually accelerate their repurchases when the stock price is more attractively priced. So when this company has a free cash flow yield, so I'm looking at the free cash flow yield to market cap of 5% plus, they usually accelerate their purchases. When it's less, it's like 2 or 3%, there's less. They think they're just doing enough to offset that share dilution. So from that point of view, I think they have been quite good at knowing when to press into their purchases. And they bought a lot of, I think in the first half of this year, they bought $800 million worth of shares, which is, call it, I think, 5 or 6% of shares outstanding. So it's
Yeah.
meaningful.
Yeah, I mentioned that in the piece. They got zero point 0.3 or something billion left, or 1.2 billion left in that program. And at first I was excited to see all the share repurchases, but then I saw this high stock based
Yeah.
compensation, and I'm not a big fan of big stock based compensations, and I wonder what you thought about how you're thinking about that. For one, the size of it is
Mhm.
seems quite big.
Yeah. So the way that I look at about stock, so in some cases, it is that's the necessary evil. So the question is this reason not to buy the company at all, or is this something that we can take into account of how you're thinking about the value creation here? So the way that I look at the share compensation is I usually look at the number of shares that are issued in any given year and what kind of dilution it is. So I think you looked in your article in percentage of sales, which is a relevant metric, but I think what's more relevant to me is how much am I diluted every year. And it looks like this company on average kind of by issues call it 2, 3, sometimes 4 million shares, but it usually ends up being 1.5 to 2 million, 1.5 to 2% dilution. So I'm looking at it as a headwind to
Okay.
my valuation is that I'm saying that the existing shares are going to be diluted by 2% per year. There's going to be buybacks to offset that, but this is my headwind. And the question is, does the company still make sense with that headwind or not? It's kind of like when we're looking at emerging market companies, you have a company operating in a country like Georgia or Kazakhstan, or Turkey, where you will have a currency that has a natural rate of decline to it versus the dollar or the euro, whatever currency you're investing in. So we what we do in that case is we instead of trying to hedge out the currency, which is usually quite expensive, we're saying, okay, there's a headwind, and there's a
Yep.
headwind of X% per year. Does it still make sense? So that's how I'm thinking about the dilution in this case.
Yeah. So that's actually, I like the way you phrase that. It's like if I'm looking at, in a company which is not in my currency and the growth is whatever 10%, but I'm getting 2% depreciation, then it ends up being net 8. And you're
Yeah,
just looking at it in a way, in the same sort of way of, what's my growth, and, my stake is going to get diluted by 2%. Then,
exactly.
what do I come up with? So that's a cool perspective there. So what do you think about these? You mentioned maybe they get to double digits, because that seems to be their longer term goal of 3 to 5 years. What are you penciling in for your model to get to valuation? Or I guess, if you don't mind, we can talk about, what do you think the intrinsic value of this thing is, or what do you think it's worth?
So the way that I'm gonna answer and not answer your question at the same time, if you don't mind. Because the way that I'm thinking about it is usually in terms of the IRR. The way that
Yeah.
when we're looking at investments is that we have, okay, here's the price that I'm paying today. Here's the value that I think this company will have 5 years down the road based on a particular multiple to earnings. You can choose PE, EBITDA, whatever it is. If there's a dividends that are paid along the way, that adds to my IRR. If there's buybacks in terms of that changes the market cap per share and out here, and what kind of IRR am I getting from that? So from that point of view, if we're looking at 5 years out, so today Akamai is trading, I think, at around like 9 times EBITDA, but historically it has traded somewhere in usually in the multiples of call it like 13x. That's the average historically, and then in the last 2 years, and it's a if you take a look at a company that other companies that are growing at high single digits, that is not an aggressive multiple at all to in terms of 13x EBITDA. So if you're thinking from point of view of this company, what is it worth if you in call it in 28? So we're looking just like 3 or 4 years down the road. At that multiple, we're getting to an IRR from current price of about 22%. So at that point, I think it's worth around $150, $160 a share. There's no dividends to speak of along the way. It takes into account certain buybacks, it takes into account certain dilution, as we discussed. So this is how we're thinking about from a valuation point of view. We are assuming some multiple expansion, but I think it is within reason, given that we expect in the revenue to growth. If we don't get the revenue growth, then we're not going to get the multiple expansion. And as we already discussed, then I would have to reassess my thesis.
Okay. So basically, what I understand what you're saying is, if you're looking out, you know, roughly 3 years, they're kicking out high single digit revenue growth,
Mhm.
pretty stable, I guess, margins. This re-rates to something like 13 times or like the historical multiple,
Yep.
and this gives you, and then also taking into account, let's say, 1-2% dilution there per year, and
Yep.
it gives you out to about 22% IRR, taking that into
Exactly.
account.
Yeah, cool. Let's make it 20% for our numbers.
Yeah, yeah,
This
yeah,
guy's,
yeah.
yeah.
Okay, okay, okay. Makes sense. Makes sense to me. All right. So, what is the? I guess what is the market missing here?
I think the market is missing, and that this is something that you've pointed out in your piece as well, is that if you look at the estimates from the analyst, it's assuming that it's going to continue growing at low to mid single digit rates. So I
Yep.
think the market is missing that inflection point from a point of view of the higher contribution to growth from the pieces that have a natural growth rate to them that is a lot higher than the company. So this is my bet, is that revenue will continue to grow at a high enough pace to deliver the inflection in revenue growth rate, which should deliver a improvement in profitability and multiples. So that's kind of the main thing. Market is usually pretty good at just drawing straight lines.
Well, the truth is here. I mean, this is it's not a very big company in today's
No, it's
context,
the
in
market
today's
cap at what,
world.
12, $13 billion.
Yeah, yeah. So 13 billion. This is mid cap, whatever. So it's not getting as much coverage, and I guess that's why you also saw the pop that happened in the last week. I mean, this has been trading around whatever between 70 and 80, and now it just boomed in like 3 days, went up to 90. It's like everyone just got
Yeah,
shell shocked or
but it
something.
really hasn't done anything. I think you mentioned that in your article as well. It hasn't done anything for 5 years. I've owned it. I have to be absolutely honest. I've owned this company for probably over a year, closer to 2 years. Within that time, initially I expected the inflection in revenue growth to happen by now, but it
Mhm.
hasn't, in part because the security revenues have that growth. That growth has slowed down from, it used to be 15% plus per year. Now it's 10. So that's a cause for concern. We discussed it, like, what could change my mind? If it goes to five, it's a problem, right?
Yep.
And also, they had a higher decline in delivery than initially expected. So if you look back to their investor day information from 22, they talk about, oh, this is about a flat revenue growth rate, which I did not think was plausible, but I thought -5 was a reasonable. It was down, I think, 12% last year, something like that. So you've had a number of disappointments that prevented the growth from inflecting. But that said, even with these disappointments in place, the revenue growth is still there. So that to me kind of shows that, okay, this company still has all the right pieces, it has the customer relationships, and hopefully it's just a matter of time. And if you look at the announcement that they did, part of the reason for why it popped, this announcement of partnering with NVIDIA, I think is a major piece of news that could lead to a inflection in growth rate, and how the market is starting to think about this company. Because if they do come out and say that, I don't know, within the next year, that we're now getting $100 million of revenue from inference or something like that, I think that's going to get market's attention.
Now there's been I see the co-founder. He owns 2%.
Yep.
He's also the CEO. Anything to comment on either him or any insider activity or anything other else regarding management?
So he's been around, as you mentioned. He's a co-founder. He's been around for a long time. He has about 2% of the company, so it's about, call it, $250 million worth of shares. It's quite meaningful. He occasionally buys shares. He occasionally sells shares. Um, so I think but also this company has in total, because of the high share comp that they're issuing, think the total employee ownership of the company is around 20%. So it's meaningful.
Oh, okay.
And then you see, whenever you will see announcements regarding sales of stock, but I think that to me is quite normal when a lot of your compensation is coming from share price, from shares, and you have to buy a house or do something. That's the type of things that you will see. If I remember correctly, so as far as the because one of the things that we look at is the KPIs for the management. They
Hmm.
usually those are revenue and EPS growth, and I think total shareholder return relative to peer group. So they are, and those to me make sense for the most part. So I think I haven't really seen that much to discuss as far as the shareholder structure. I think they've done a reasonable job. I like the high insider ownership by the employees because that, once again, I think that improves the company's culture as well.
Okay. Okay. That's great. So I think we've pretty much covered it.
Good. This was very good.
And I think people will find this find this useful. Let it to you if you have any other comments to make regarding Akamai, or otherwise we'll round it up, and you can just give us a quick final summary, I guess.
No, so I think we covered most of it. I think if we just to summarize, there's this falls to me. We within the fund we have three different categories of securities that we invest in. There is companies that cash flow growth at reasonable price. What we look at those, it's usually companies that are growing at 5% per year or more, delivering a lot of cash flows, allocating that capital smartly. That's one category. Second category is what we consider to be value with a moat. So those are the companies that are usually growing between, call it, 1 and 5% per year. We do want to see the end market increasing a little bit. Those companies usually not very expensive, and they're delivering value through M&A and through capital allocation. That's quite often, if it's a company within our portfolio, more often than not, we will be trading at a fairly low multiple to the free cash flow yield that it's generating. And then the third category of companies is what we call growth with temporary problems. So it's companies that can deliver growth that is double digit if everything is done right. But for one reason or another, they do not. And when we get these companies right, and in the past we invested in companies like Chipotle, and we invested in companies like Arista Networks that fall within that category. When they get that growth, when they fix whatever has been going on with them, and they start delivering the growth that we expected, then we get the profit expansion, we get the multiple expansion, and we get an exponential growth in stock price as a result. To me, Akamai feels like it could be that type of company. We have it within that category of investment. And I think that's kind of, and we talked about the main competitive advantage is the network that they have and the relationships that they have. And if they do use all of these things right and they combine them, they could be the type of company that is growing 10% plus per year, even though they have been around since the 90s. So that to me is the core thesis. And thank you so much.
Thank you, Steve. Is if people want to contact you, how would they do that?
So Firebird has a website, www.fbird.com. Over there, if you're interested in our funds, there's some information in there that could be quite interesting, both on Eastern European funds and the US fund. I'm on Twitter, but honestly, or whatever it's called now, X, because I refuse to pay for the blue check mark, I don't really do that much over there, but my handle there is at Steve Gorelik, so you can probably find me there and contact me. I'm also on LinkedIn, but yeah, always, as I
Yep.
mentioned already, I part of the reason why I do these podcasts is to hear back from the investment community and tell me that I'm an idiot and engage into a fruitful discussion as a result, from which I'm hoping to learn. So hopefully something like that happens here.
Great, great. I will put those links down within a piece on Substack so people can click on that. I'll try to put that also in the podcast and in the YouTube description there, so you guys can click on that. So it's Firebird is fbird.com. And actually, we did a podcast a little while ago
Harvey, that's right.
with Harvey Sawikin, which was on Bank of Georgia, and I think Bank of Georgia did well after that. Did pretty well after that podcast. So I'll put a link to that as well. So, check
And you should
that
also
out.
put the link to Harvey's Substack.
Oh yes, yes, yes. I do have Harvey's Substack as one of the recommended
It is.
Substacks on
I look
my
forward.
Substack as
I
well.
have the pleasure of talking to Harvey practically every day, and it's truly a pleasure. But even with that, I learned a lot about him by reading the Substack, and it's truly enjoyable.
Yeah, so Harvey, he has a Substack. He's also written written a book. Super interesting guy. And if you've enjoyed the podcast with Harvey and with Steve today, then I would say sign up for my online conference in December 4th and December 5th. It's Thursday, Friday, live and recorded, where you'll be able to ask questions directly to great investors like Steve, who will be pitching ideas over 2 days. And you can check that out at fatalphavalue.com/online. I'll put a link to that as well. Steve, thank you so much. And just heads up, I'm going to be in London for the Chelsea Paphos game in January.
Ooh,
So we got to get together for a
absolutely.
beer. Thank you very much, and we'll talk again soon.
Thank you, Sophocles.
The podcast episodes should not be copied, distributed, published, or reproduced in whole or in part without the prior written consent of the host. These recordings are for informational purposes only. This recording does not address all risks. The podcast is not intended to be relied upon as a forecast, research, or investment advice, and are not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy. The views and opinions of any podcast participants are subject to change and are not necessarily those of any companies affiliated or associated with the participants. The participants cannot guarantee the accuracy of the information in this podcast and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. There is no guarantee that any forward-looking information will come to pass. Reliance upon information on this podcast is at the sole discretion of the reader and/or listener. Past performance is not indicative of current or future results. This podcast is being made available for educational purposes only and should not be used for any other purpose.